In a monetary inflation world, okay, you similarly don't buy bonds, but what you do buy is dedicated monetary inflation hedges. Look at the relationship, this is a short-term relationship between the 6-week changes in the price of Bitcoin and global liquidity. This is showing that harmony. Global liquidity leads by about 3 months, so it's a very keen lead indicator. In a monetary inflation world, the gold price and Bitcoin go up significantly. It's not simply saying, I don't want to own bonds, it's thinking what I do want to own.
Hello and welcome back to Soar Financially, a channel where we discuss the macro to understand the micro. My name is Kai Hoffman, I'm the edgier mining guy over on X, and of course your host of this channel, and I'm looking forward to bringing back the king of liquidity, Michael Howell. He's the CEO of CrossBorder Capital, frequent guest here on the program, and I really enjoyed chatting with him because he really paints a different picture. He looks at global liquidity flows, and especially after the Liberation Day, we need to discuss liquidity. JGBs, what's happening in Japan? Had a bond auction last night. How did it go? It's been talked about a lot that the Japanese yields are a big impact here on the global liquidity flows. Of course, China stimulus and what is the U.S. bond market telling us? So much going on right now, and we need to start interpreting the signals and understand what is happening. That's why I brought Michael on. But before I switch over to my guest, hit that like and subscribe button. It's a free way to support us, and we tremendously appreciate that. Now, Michael, it is great to have you back on the program. It's good to see you again. How are you?
Very well, Kai. Good to be here. There's certainly lots to unpack in markets right now. They're going all over the place.
Absolutely. No, lots going on. We had a bond auction last night in Japan that seemingly went well. We'll discuss a little later. But maybe as a can opener, Michael, I'm going to quote one of the titles of your latest Substack here. Has the U.S. Treasury lost control of the bond market? And curious what your takeaway here is, Mike.
Well, I think the subheading said it all, which was spoiler alert, yes. The fact is they have. Yields are going up. And I think the question is we've got to try and understand what is the new normal or what is the old normal, probably is a more accurate way of putting it, in terms of yields. Now, what I can do is I'm going to try and find a chart which demonstrates the issue at hand. And that is that I don't know whether you can see this slide I've put up.
Yep.
This is looking at the US term structure of interest rates. Now, what this is basically showing are 4 lines. The red line at the top is looking at the average term structure, in other words, the slope of the yield curve across different maturities, which is shown at the bottom, different bond maturities. These are treasury yields. On average, through the 1976 to 1982 period. Now, I think that most people would kind of argue or confirm that those were the stagflationary years in the US. And this was a time when interest rates were high, the economy wasn't doing terribly well, inflation was a nagging problem, and we had the era of Volcker, who came in and basically sharply hiked interest rates. Now, I'm not saying we're necessarily going to get back to that level, but what I'm doing is putting that as a marker to show where we've come from. And if you look at the lower curve, that is the brown one at the bottom, is the average yield curve that we had in the post-GFC global financial crisis period. And what you can see is that curve is upward sloping, but it's very, very low. So in other words, the 1-year tenor, you've got virtually zero interest rates, and at 20 years, you're barely at 2%. Now, we've moved on from that, and we're basically at the orange line, which is the latest US term structure. And you can see that sort of averaging around 4, although longer durations are up nearer to 5%. And then there's a broken line, a brown broken line in the middle, which is the average yield curve over the post-World War II period. Now, that's the benchmark that I think we ought to be thinking a lot more closely about. That's where we're moving to. And I think that, the Federal Reserve at the moment is sort of grappling with a period where they're probably believing that we're in a stagflationary mix. And just to put some bones on this particular graph, and I won't dwell on this next one very long, but this is the data that is behind that looks at different yield curves for different countries in different periods. And you can see that how I've averaged them out. So this is actually real evidence of what has been going on in markets. So that's the flash.
Yeah.
Now, what's driving this is really a number of features, but the main thing, without getting too wonkish, is something called term premia. And what I want to do is just to illustrate for a moment that background and just put into context what is the real issue out there. This is showing daily term premia for the big bond markets from the beginning of January this year. Okay. Now, let me first of all say, what is the term premium for people that don't understand fully bond markets? Bond markets or bond returns have two components. One component is the expectation of what interest rates will be doing over the lifetime of the bond. So in other words, for the US bond market, it's what the Federal Reserve is going to be doing with its interest rate policy for a 10-year bond over 10 years on average. But there's uncertainty with what the Fed does. And so the markets will demand what's called a term premium. In other words, an extra compensation, a cushion, if you like, for the uncertainty over the lifetime or term of the bond. And that's called a term premium, which is normally positive because you want some insurance policy when you own a long duration bond. And you can see on the chart what the direction of term premium of different bond markets are. The top line, which is the broken orange line, is the French OAT market. The black line just below that is the British gilt market. The German Bund market is shown there in orange. The US Treasury market is in red. And the broken black line is the JGB Japanese bond market. Now, first thing you can say is that, number one, all of those bond term premia are increasing from January through to now. There's a trend increase in those term premia. It's been bigger in some countries than others. And actually what you can infer from this, if you look at the red line closely, is actually the US has come out of this very well. The US term premia hasn't gone up very much. In other words, what we're saying here is that all this talk about the US losing its safe haven status, which is very widely quoted in the media, is just complete rubbish. That's not what the bond markets are saying. If you look at what's going on, this is an international phenomenon. This is not just America. America clearly is suffering too, but effectively the US is becoming more of a price taker in bond markets than a price maker because yields are under pressure worldwide. Now, why are those yields under pressure? First is, if you look at the Bund market in Germany, there's been a step upwards, which has been reflected as well in the Haute market in France. And that is because of the debt brake being released and markets anticipating huge amounts of new issuance coming on. On top of that, you've got a change in policy in Japan, whereby the BOJ, which has been vacuuming up or hoovering up huge amounts of Japanese government bonds over the last few years, has reversed that policy. There's an inflation problem emerging in Japan now after all this stimulus that they're throwing at markets. And the new BOJ governor, Ueda, is now actually, as of last night, is saying, well, we're going to keep, plowing this furrow now. Yields are going up, but we may be raising interest rates as well. So notwithstanding the fact that you actually had quite a good bond auction, which I would suggest was anyway probably manipulated, but that's Japan. What we've got to face is high yields. Now, this is looking at what's happening in Japan. And these are the two key components of the Japanese bond market. One is what the market is assuming peak rates will be over the next 20 years. So you can see how that expectation, the black line here, has changed in the last few years. And broadly, since, let's say, 2023, what you've had is a significant increase, 150 basis points increase in market expectations of what Japanese terminal policy rates, what the BOJ will be doing. That's a big, big change for bond markets. And then you've got at the bottom, the term premium on the JGB is increasing. So what that means in sort of yield terms is shown here. The dotted line at the top is looking at the Japanese JGB yield, the yield on the 10-year bond, fair value estimates. The grey bands that we've shown are policy interventions, so-called QQE quantitative and qualitative easing, and then YCC is yield curve control periods. And then the actual yield is the orange. And you can see now the brakes are off in Japan too. Yields are starting to converge upwards at the higher level. So this is not good news, is the bottom line. And I'm just going to finish here on one, when I'm talking about bonds, on one chart, which is the US 10-year, which I'm just going to show you here. This is the picture for the US 10-year Treasury. This is the yield that really everything is priced off in world markets. And what this is showing is on the top area of the slide, the orange line is looking at the 10-year yield itself. And what is driving that, in our view, is principally that black line, which is the US term premium. And that's starting to rise significantly for various reasons. But when I said international yields are increasing, there's also a lot of issuance going on in the US, which we can dig into. But broadly, the trend is upwards. And my last point on this is that even though in April we saw widespread scares, and maybe they've been reignited by the ISM yesterday, the very weak ISM survey in America, there's been a lot of concern about US recession. But actually, even though there was concern about US recession, the 10-year Treasury barely dipped below its 200-day moving average over that period. And that's very unusual. So the bond markets are concerned by something, and it's not recession. It's probably a stagflationary environment. And therefore, we think that you've got to get used to probably 5% yields, and you've got to anticipate a Federal Reserve that is operating a monetary policy now with stagflation in mind.
Yeah, they've been saying as much, quite honestly, but without saying stagflation, right? And
exactly.
Weaker economic growth, higher inflation based on the policies that they're seeing. That's what put Powell into hot water back in April as well, when his position, his job was highly questioned by President Trump there, and it quieted down rather quickly, but there was a lot of noise around Jerome Powell's job there. Real quick on the charts you showed the term premium, of course, and the 2-year. I've noticed the U.S. term premium looked a little bit like a banana. Really using technical terms here, but my point is, though, curious if you can tell from that chart as well whether there's more demand in short-term bonds or short-term debt as well than in long-term debt, if that's a fair assessment, because you have that dip around the 2-3 year mark on average. Is that a fair thing to say? Is there more interest in short-term bonds right now?
Yes. There's a lot of this goes back to where on the curve the US government is issuing paper. And I think that, what you've hit on is a very interesting point, because the other thing which is going on, which you may have picked up from recent media reports, is that the US is doing a lot of funding at the short end of the market. And it may be doing that, as you rightly say, because opportunistically there's a lot of demand there. And investors are not really wanting to buy long-dated debt because of the risks that are involved with rising term premium and falling bond prices. But actually, if you look at what's happening in Japan and in the UK, both of those two governments have actually said they're going to start issuing now much more at the shorter end of the market. Now, this is highly dangerous. And this may be what the bond markets ultimately are getting concerned about. It may also be what the Federal Reserve is getting concerned about. So there could be a tension opening up between the Federal Reserve and the Treasury in the US because of the differences in policies. Now, what I want to show is that particular process. And maybe the best way to start is to look at this chart, which I think is a very illustrative one, although I've got to explain what's going on here. What this is saying is the black line is a nowcast of US GDP momentum, which is daily observations of what we think the tempo of the US economy is doing from all the ongoing data releases. It's very much like the Atlanta Fed GDP now, but this is our own version of it, but effectively saying the same thing. And what it's showing is that the economy is slowing down. It's sort of at a low point, as you can see from the black line. The orange line is the market's expectation of the number of interest rate cuts that the Federal Reserve will undertake over the next 12 months. And as you can see, right up until the end of 2024, there was a very high correlation between those two lines. There's a breakdown we get around the beginning of 2025. And I think that is the Federal Reserve coming out with more hawkish language and starting to get the market ready for the view that they're not going to be cutting interest rates aggressively through this year. And you can see that disconnect that's very clearly opened up. Now, this data, by the way, comes directly from the term structure. It's not the Fed. It's not from Fed funds futures, just to be clear. It will have the same profile as Fed funds futures, but it's actually taken from the curve. And this is telling us that there is a gap where the Fed seems now more concerned about inflation than it does about US economic growth. And that is a very clear sea change. Now, this next chart probably may tell us why. And what we show on this chart is an orange line, which is break-even inflation rates according to the TIPS market, the inflation, the Treasury inflation protected security market. In other words, the real bond in America. That's what you infer. That's what the bond market is telling you. 10-year inflation is on average 2.25%. Okay. The black line comes from the University of Michigan's consumer survey of what it is telling us consumers are anticipating the inflation rate being. And this is showing what their expectations are. And you can see that big jump in the data. Now, that's coincident with tariffs, and clearly consumers are very concerned about inflation. And it would seem to gel very much with the election result last year in the US, where a lot of surveys were saying that voters' greatest concern was inflation, even though it wasn't evident at the time in the CPI basket. So it's probably telling us that underlying inflation pressures that are being picked up, on the shop floor and in the stores is actually much more pronounced than the statisticians say. So this may be another piece of evidence that underlying inflation is actually more of an issue in the US than not. Now, why is that an important element to try and understand in the context of what the Federal Reserve is doing? And that is because if you look at this chart, which is a tad wonkish, but I'm going to try and explain what is going on here. This is showing the distortion that is affecting bond yields in America right now. If you look at the orange line, that is the 10-year actual yield. The black line is in fact an estimate that we've bootstrapped from the mortgage-backed securities market. Now, the mortgage-backed securities market is a government-backed market in America. It's a risk-free market. It's not a treasury, but it's very similar to a treasury. But it has very different bond characteristics in the sense that bonds of longer duration, in other words, they mature 15, 20 years out, and they have more convexity, which is again getting into bond math. But aside from that, you can adjust them for those two characteristics and bring them back to an equivalent treasury 10-year bond, which we've done. And therefore, if you do that, what you find is there's a big gap has opened up. And if you look at history, that gap is very, very unusual. And it does happen at times, but it's very unusual. What's driving it? Bang, here's the answer. What's driving it is treasury bill issuance. Now, this is Yellenomics, okay? Janet Yellen, previous Treasury Secretary, basically funded the US government through the bill market in the wake of the COVID emergency. That was understandable at the time, but it kind of went on too long. And they were starving the market of long duration coupon debt. And basically, yields were pulled down at the long end of the market because there was just no coupons to satisfy the needs of the pension funds and the life insurance funds. And therefore, effectively, the yields on those securities dropped. What you can see is that as they issue lots and lots of bills, what you get is that yield gap between the bootstrapped yield and the actual yield widens out. In other words, actual treasury yields get depressed by this excess demand. If bill issuance continues at a very, very high rate, you would expect that yield gap to be sustained. What we've projected in here is what we think Scott Bessent, the new Treasury Secretary, will do. He originally said he would cut back significantly on bill finance. I don't think he can do that. I think he's boxed in. Notice the fact that others are trying to follow this, the Japanese and viz the UK as examples. So we're in a world now where funding is at the short end of the curve. Now, what that tells us is that yields are going to rise. In other words, they're going to close the gap, but that gap is still going to persist because of this excess growth in Treasury bill issuance. Now, the problem that fosters is that what this is pure monetary inflation. And what I want to try and show is this chart that I've just put up, which is demonstrating that phenomenon. Now, what that tells us is that it's not the Federal Reserve's QE that is mattering right now. It's the private bank's QE that is effectively mattering. And what you've got is the private sector is monetizing government debt. Now, again, this may be straying into the weeds of being a little bit wonkish, but the fact is that if the government sells any security to credit providers, they expand the credit provider's balance sheet by definition, and that is a monetary and credit expansion. And it is a way of getting money supply growth growing faster to monetize the deficit. And because the banks love bills and short-dated debt, and the fact is that governments are turning more and more to banks to buy this stuff up and issuing that in that area of the market, you're getting debt monetization. Think of the SLR, the supplementary liquidity ratio debate, which is all about eliminating that to help the banks. That is another way of just selling more debt to the banks. This is not trying to help the banks. This is trying to help the US government fund itself. And I think my prior slide here was saying, look at the federal deficit year after year. The black line is the current calendar year. The dotted line in orange is 2022. The orange line is 24 and the dark red is 2023. We are just traveling along that same course, but with the big, beautiful bill likely to cause a big step up at the end of that period. So there's a lot of funding to go, and they're using the short end. That is dangerous. That is monetary inflation, and that is explaining why you've got things like gold and Bitcoin going up the whole time.
Lots to follow up on there, Michael. You touched on the inflation, maybe hidden inflation to a degree as well. U.S. officially at 2.3%. We got Eurozone inflation numbers this morning, Michael, and it looks like the EU, let me just get here on full screen here again, but the EU, like the inflation fell below expectations, 1.9%, which seems to be leading to another rate cut in the EU. While the world is cutting, the US is holding steady, or even to a degree, maybe even thinking about raising rates due to tariff uncertainty and things like that. Is the US really that much stronger than the rest of the world that they don't have to cut, or is it just really all inflation driven? I'm trying to understand that dynamic a little bit.
I think it's inflation driven. I don't think the US economy is necessarily a lot stronger. The fact is that the stimulus effect of a lot of the policies that Yellen undertook are fading. I mean, we can see those. I think I've got a chart. If you look at the chart I've just put up, this is looking at the combined US Federal Reserve and US Treasury stimulus to the economy through various means. Now, again, these are sort of using some of our terminology. The QE, I think people understand. Not QE. QE is the backdoor mechanisms that the US Fed was using, such as the rundown of the Treasury General Account, the rundown of the reverse repo program. These are ways of actually getting more liquidity into the system. And then the not yield curve control is again a technical thing, but that's saying, well, actually, if Janet Yellen was funding at the short end of the market, issuing a lot more treasury bills rather than coupons is actually a net stimulus in liquidity terms to the market, is equivalent to a liquidity boost. And you can see those effects. Now, what we've tried to show is what happens through the rest of 2025 and 2026. And we think that what's going on now is that you see that black area, which is what the Treasury is undertaking through funding, is starting to increase. And that is saying that, okay, we know there's a big deficit to fund, but they're going to have to monetize that more and more. So what you've got coming in sort of through the back door here is further monetary stimulus, but by issuing at the short end. Now, the Federal Reserve may not like that backdrop, and that may be why the Federal Reserve is deciding to sound tough now in terms of what it's doing on interest rate policy. There seems to be a conflict in these policy dimensions, and that's something I think to think about very seriously. Because if the Treasury is monetizing, but the Federal Reserve is worried by inflation, the Fed ain't going to cut interest rates anytime soon.
Yeah, makes sense. On the topic of the Fed, I asked you, Michael, earlier before we hit the record button about the system open market account, the so-called SOMA account. A guest on our program brought that to my attention, that there's been some buying lately in the bond auctions, that they've been hoovering up some 20-year bonds here. How much out of the ordinary is that? How much do you usually see SOMA come into those bond auctions? Because they hold quite a bit of bonds and bills, but I'm curious if you're seeing anything out of the ordinary there, anything that we should be concerned that is upsetting the system potentially.
I think a lot of these things are fine tuning. I wouldn't read too much into those into those movements. I mean, we're talking, comparatively small amounts. I mean, 20 billion is not really going to move the dial much. But I think that, the fact is that, what we're moving to is a situation where we've got fiscal dominance really coming through here. The deficit is a big, big burden to fund. America cannot rely on international buying now, partly because, some of the actions that Trump has done have alienated foreign buyers, notably the Chinese, but, potentially the Japanese as well. But after all, Japan's got its own problems. Europe may be sort of scratching its head and thinking, do we really want to be committing a lot of money into US government bonds, et cetera, et cetera. A lot of the buying at the margin has really come through from hedge funds. I mean, you can see that because the big centers like London, Cayman have been, major buyers of US treasuries. So that may just be a round tripping trade, basis trade, for example. So there's not sort of genuine end user demand. So all these things must be sort of bothering the bond markets and the treasury right now. So this whole funding problem is really an issue, and kind of explains why the treasury is going very much at the short end. But, there's all these things which are being unwrapped, like the SLR, as I mentioned, getting the banks to buy more treasury debt. I mean, these are big, big issues. And, investors have got to think very seriously about how they allocate assets in a world of monetary inflation. And one of the things that we keep, maybe banging on about is to say, look, this is not financial repression. I mean, I think that financial repression is a bit of a misnomer anyway, because what financial repression is really is a sort of textbook world which says, okay, what the authorities can do is that they can deliberately force interest rates below nominal GDP growth rates, okay, and that gives everyone a free lunch. Well, if that's so good, why don't they always do that? But they've always struggled to get interest rates below nominal GDP growth in the long term anyway. What we're looking at is something more subtle. It's not financial repression, it's monetary inflation. In a monetary inflation world, okay, you similarly don't buy bonds, but what you do buy is dedicated monetary inflation hedges. And what I want to show is a chart right at the beginning of the presentation, which is actually a critical one to understand. And that's this chart. And what this chart is looking at is the disconnect between gold bullion and real interest rates. Now, historically, many analysts have said, well, okay, because gold doesn't have any carry, the opportunity cost of owning gold is real interest rates. That's quite plausible. And if you look at the chart, what it shows is US real interest rates from the TIPS market from 1998 onwards, and compared with the price of gold. Now, the fluctuations in the gold price pretty much move with fluctuations in real interest rates flipped over. So you can see that real interest rates, if the black line goes up, the real interest rate is falling, and therefore the gold price should go up, and it does, and similarly vice versa. But look, there's a big disconnect in 2022, and that's what I labeled Yellenomics. And that's when you start to see this sort of disregard for prudent fiscal management starting to appear in the US. And that is the concern that we've got. They're undertaking monetary inflation. in a monetary inflation world, the gold price and Bitcoin go up significantly, as do other monetary inflation hedges. You might throw into that some large cap stocks that have got pricing power. You might think about prime residential real estate. Those type of things go up. The sort of things that did well in the 1970s. And that's what we've got to start thinking about in terms of investment portfolios. It's not simply saying, I don't want to own bonds. It's thinking what I do want to own. And it's monetary inflation hedges. And that's really the key thing. Now, if you want to look at this arithmetically, I've tried to show in this slide what the background is. And this is basically saying, look, this is trying to understand the core of our analysis, which is thinking about what we call the debt liquidity cycle. Now, I can come on and explain that in a moment. But broadly speaking, what this chart is indicating is the future or potential growth in liquidity over the long term. And liquidity is driving the whole system, all asset prices in our view, which I will demonstrate again in a moment. What the top line is saying is that liquidity is driven by debt. And debt, as you can see here, debt is growing exponentially because we know that the U.S. government is growing its debt rate at about 8 to 9%, which we demonstrate in that little equation at the bottom. So if you look at how U.S. debt is increasing, the mathematics of that illustrate. You've got an interest rate on the debt of about 4%. You've got a primary deficit component, which is basically a primary deficit as a percent of GDP, which I've said is 4 to 6%, and a debt GDP ratio of 120. And that gives you a primary deficit relative to debt growth. And that's the component that is driving this system. This data comes from the Congressional Budget Office, an independent arbiter in terms of US finance. They do not allow for a recession in the US. Every recession that we've seen recently has added 4 to 5 percentage points to the deficit, the primary deficit. That is the big worry. So the compound rate of growth here in US debt looks to be at about 8 to 9% per annum. Why is that important? Because that is driving liquidity. And if you look at the equation, assuming that the debt liquidity ratio is constant, which is a precondition for financial stability, liquidity would go up with that debt. And that is the monetary inflation dynamics of what we're looking for. In a world where liquidity is growing at 8 to 9%, you need to think about dedicated monetary inflation hedges. And that's principally what we're talking about. And what I can do just very briefly is just illustrate a couple of those points. One is to say, this is the MSCI World Index against global liquidity. If global liquidity is going up further, which it is in the long term, then you've got to say, I want large cap stocks because they're going to do well in that environment. Also, look at the relationship. This is a short-term relationship between the 6-week changes in the price of Bitcoin and global liquidity. I could have done exactly the same thing for gold, but I used the real interest rate chart for gold instead. This is showing that harmony. Global liquidity leads by about 3 months, so it's a very keen lead indicator in terms of Bitcoin. This is it against all assets. So here is global liquidity, and the orange line is world wealth, and you can see what we've projected through end 2025, and that is basically saying you're coming to some peak in terms of growth, but the underlying growth rates of global liquidity should be sustained. And that's important, a very important thing to watch. What should investors be monitoring in this? They should be monitoring what debt growth is, and they should be thinking seriously about the risks in the system. And the primary risk, which I'm going to come on to, is this chart. And this chart is looking at the debt liquidity ratio that I was discussing earlier on. I said that has to be constant for financial stability reasons. That financial stability is demonstrated by the annotations. And what it shows is the ratio between total debt for the advanced economies worldwide and the pool of liquidity in the world. every financial crisis going back to 1980 that we can see here is a refinancing crisis that has been caused by an inability to roll over debt. The problem with debt is it doesn't go away. It needs to be rolled over or refinanced. And that refinancing process demands liquidity. It demands balance sheet capacity. And that's what you can see demonstrated. When you get tensions, a very high debt liquidity ratio, then you find that there are issues of refinancing and you get a financial crisis. Central banks have to come back in, pump in liquidity and bring that ratio down. When they overcook it, when there is too much liquidity relative to debt, you get bubbles. The Japan bubble, the Y2K bubble, the US housing bubble, and now the cryptocurrency boom or the everything bubble, which we've just been in. Why is that bubble so pronounced? Number one, the GFC, solution liquidity. Number two, COVID, solution liquidity. And they also put interest rates at near zero, which is an unprecedented amount. When I began in the financial markets, I was at Salomon Brothers. The Salomon Brothers was a sort of key researcher of the bond markets. Sidney Homer wrote a book, which is sort of the doyen of bond analysts, which is called A History of Interest Rates, that goes back 5,000 years. Nowhere in that book is there any mention of zero interest rates because it didn't happen. It only happened during the COVID years. And, if you go back to ancient Rome, interest rates barely fell below 4%. If you go to ancient Greece, it was barely below 6%. If you go to Britain in the 19th century, yields averaged 3%. Even in Renaissance Italy, they were sort of between, they were around 4% or minimum 4%. So you can see zero interest rates are so abnormal. And what that meant was that debt was turned out into the 2026, 27, 28, 29 period by issuers who were sitting on debt during the COVID period. They just took great advantage of zero interest rates and they turned their debt out. Problem is that debt's coming back and that will absorb liquidity. So what central banks have got to do here is to keep an eye on that process. And that's what we do. So we're concerned that what we may be getting now is a temporary blip because central banks, at least the Federal Reserve is threatening to sit on its hands a bit here because it's concerns over inflation. Whereas you've got all this debt, which has got to be, which is being turned out into the next few years, coming back to be refinanced. And that's really an issue. So we may be getting some tensions, and that's why investors have got to be, very alert to that. That may cause sell-offs in markets, that's for sure. It may cause volatility. I think that's a buying opportunity because the long term is definitely more liquidity because debt is the bogey we've all got to get out of. And just think, no politician is ever going to think about cutting spending at all. It's a guaranteed election loser. So no one's going to do it unless there's a serious crisis.
Tough one, absolutely. But maybe to summarize, you're not forecasting a liquidity crisis here in the near future, despite your chart.
I mean, just to be clear, this is the mechanism you can see that we look at, and this is the debt liquidity cycle. And in terms of looking at the tensions, if you look at the left-hand side of that, there are two things that people need to monitor very closely. One is the SOFR spread, in other words, in the repo markets, and the other is the MOVE index, which is an index of bond volatility. And just to illustrate that, here is the MOVE index of bond volatility. And if that starts to move upward sharply, then you've got a problem. And you can see where I put the normal zone. We're just sort of at the top of the normal zone right now, but we've been dancing around in that space. If you get up to the danger zone, then you've got a real problem. But one of the things that actually, to come back to your SOMA example, one of the things that the Treasury is doing in the US is it's engaging in debt buybacks. It's taking off-the-run bonds out of the market and putting new, fresh, on-the-run bonds on the market. And that is improving liquidity, and that's helping to get volatility down. So they're alert to the problem. The other is looking at this, which is looking at the repo markets and looking at collateral shortages. So this is really saying, is there an absence of good quality collateral to borrow against, or is there a lack of liquidity from credit suppliers? And those tensions come out in terms of a very high or spiking SOFR spread, as you can see there. What we've been arguing of late is there looks like a worrying trend here that the Fed is sailing very close to the wind, and you can see more and more evidence of these spikes occurring. So that's not comforting news, but we got to watch this space. Providing you're in the tram lines for both of those two indicators, things are probably okay. But this is a danger. So I think there are, my view would be, I wouldn't be chasing markets now. I think there's sufficient uncertainty to be concerned, but I think the long term is definitely there because of this monetary inflation. I know I didn't talk about China, but I'm happy to discuss China, which is a different animal right now.
I was going to say, I have a chart queued up right here, and it's 10 years of the 10-year Chinese bond, and the yield is 1.7, and it's been dropping over the last 10 years. Like, you know the chart. You probably don't have to look at it. But 1.7%, it's ticking up a little bit right now for the Chinese 10-year. Explain the Chinese market. It looks completely contradictory to what you've been discussing about the Western markets and what you've been looking at. It's moving complete opposite direction. Why is that? And just explain how it works there.
It is. I mean, the fact is that China has deflation. China has deflation for two reasons. One is that they've got a huge debt burden. That huge debt burden is slowing the economy significantly. It's causing some capital flight out of China. We know there are capital controls there, but that still doesn't stop some money or a lot of money leaving. And as a result, the Chinese have had to operate until recently a very tight monetary stance to hold the yuan pretty stable or as stable as they can against what has been up till now a very strong dollar. And that has actually caused a further problem in the Chinese economy. So they've squeezed on top of this debt deflation, and they've actually pushed the economy, or certainly they did in 2024, to a very low ebb. Now, policy has changed in 2025. It's changed because, number one, the dollar has weakened, so it's given a degree of slack to for the Chinese authorities to ease policy. Secondly, you've had the tariff concern, which has added a further twist of deflation, and it's caused the policymakers in China to want to stimulate the economy. The chart I've just put up is looking at the People's Bank, in other words, the central bank in China's net liquidity injections. And what they're doing there is that they're injecting huge amounts of liquidity into their system. Now, at the moment, or the latest values, this is showing a 6-month rolling sum, seasonally adjusted to give you some idea of the trends. They've injected about 8 trillion yuan over the course of the last 6 months. And that injection is about $1 trillion US. Now, to get out of their debt problems, we suspect they're going to probably have to double that. So there's a lot more monetization going on, monetary inflation. One of the things that you detect, anecdotally, I would stress, Kai, is that brokers in Hong Kong, crypto brokers, are saying there's huge demand for cryptocurrencies coming out of mainland China. And that is because, people want hedges. We know that the gold price has been going up, and therefore, what is China really trying to do? And this is the chart that we've been using to try and explain what's going on, rightly or wrongly, but it does give, I think, a way into understanding the backdrop right now. What we have is 2 lines on the chart. The black line is the Chinese yuan US dollar cross rate, which is the rate that everyone really knows and looks at. And you can see that was up at 7.37, testing 7.4 yuan to the US dollar. And now it's dropped back to about 7.2. So it looks, there's a degree of slack in that the Chinese authorities can use. But it's the orange line. This is really the interesting one. And that's the yuan gold price. And what you can see there is a staggering increase in the yuan gold price from middle of 2022, early 23, when it's pretty much doubled since that point. And that, I think, is the interesting point to ponder. Now, we made a projection last year which said that if you look at the Chinese debt to liquidity ratio, going back to my earlier discussions of the importance of the debt liquidity spiral, The ratio in China is about 30% at least above where it should be for equilibrium. So there's way too much debt relative to liquidity. Why? Because we know they funded a lot with their debt, particularly the land sales and local authority debt, etc. And they've been tightening liquidity up until recently. So that ratio has been sky high. And that's the problem, threatening financial instability. So they've got to get out of that. And the way they get out of it is printing liquidity. And therefore, that's what they've done. Now, in order to get out of a debt deflation, they need to devalue their paper money. But they really need to devalue their paper money not against the US dollar, but against real assets. And gold is a real asset. So if they want to dig themselves out of this real estate or excess debt problem, then they've got to let their paper money devalue significantly against gold. And our projection last year was that in order to start the process, bear in mind I said start the process, they've got to get the yuan gold price up to about 26,000 yuan per US dollar. Sorry, per ounce of gold. It's currently 24,000. It's up there, getting closer, but it's not there yet. So they need to devalue even more, which means printing even more money. So what I'm saying here is that if we join the dots globally and parche the fact that the Fed may be temporarily sitting on its hands, what we've got is a world of monetary inflation. It's happening in China because they have to. The debt problem is so big. It's happening in the US because the debt problem is so big. It's happening in Japan. It's happening in Britain. It's happening in Europe. The only way these governments are going to afford their fiscal spending is to monetize debt. And the one thing that I would say for all gold investors, which I know you're one, is to think about this: is in year 2000, or from year 2000 to year 2025, the stock of US debt has increased by around tenfold, 10 times. Okay, so you're now marketable debt is just over $28 trillion, and it was about 2.8 trillion in year 2000. So in 25 years, you've gone up 10 times. Okay, what has the gold price done over that period? It's gone up 11 times. So gold has matched that, and gold is a monetary inflation hedge. That's what history tells us. Bitcoin's done more, admittedly, but this is what you want to start thinking about: is monetary inflation hedges. And there's a chart I'm going to turn to, which is basically shows the sensitivity of different assets to liquidity. Now, this is arithmetic, but it shows the sort of things that could benefit from more liquidity. And these are multipliers. So what we've done is we've looked at the impacts of a 10% shock to global liquidity through what is called a VAR framework, vector autoregression model. And what it's looking at is the multiple or the parameter on each of those assets. So in other words, what that's saying is that let's take gold. Gold goes up 1.8 times after that shock. So in other words, gold should go up 18% for a 10% global liquidity shock. And you can see the comparisons between the average beta over the period and in the last 18 months as a point in reference. Gold has been absolutely on track, and you can see all the other assets that are listed. Cryptocurrencies have a very, very short window. So the cryptocurrency data here only began in about 2015, certainly for Bitcoin, others even shorter. And therefore, it's very difficult to get a real handle. But it looks as if they are more sensitive. I mean, that's intuitively correct. And then you've got on the far right, more traditional asset classes like commodities. You've got the MSCI World Index. You've got the SPX, the S&P 500, for example, and NASDAQ. And all of those are very liquidity sensitive. But what you find is that bonds you tend to lose money.
Michael, maybe last question as well for you here. Is there a clear winner in the tariff war? Is there anything that the bond market or liquidity markets are telling you who's winning? You were talking about capital flight from China. I think we're seeing capital flight out of the U.S. as well. I know I'm trying to simplify a very complex topic here, but can there even be a winner?
Well, I think that the line that we've taken is that even if Trump wins the tariff war, the risk is of losing the capital war, and the capital war is much, much bigger. And that's what America needs to do. It needs to maintain the integrity of its bond market. and it ultimately needs to maintain the integrity of the dollar. And it's not doing either of those tasks particularly well right now. I don't agree with the view that this is already the end of the dollar, and we're looking at that now, and we're looking at a bond market that is completely out of control. I draw a line there. I think it's fair to say that we're maybe beginning that process. We could be, because other bond markets are also being affected by the same problems. And I gave evidence right now of term premium around the world. It's not just a US problem. That, in a way, makes it an interesting issue because gold and Bitcoin are global assets, whereas the S&P or the Shanghai stock market are local assets. So if you want to protect against this global phenomenon, that's what I'd be thinking about. And in a world where there's a capital war, I don't know if anyone necessarily wins, but you've got to get dedicated monetary hedges, because if this is a war economy, what we know is that monetary inflation is here to stay.
No, fantastic, Michael. What another masterclass! I love having you on. It's so insightful. Talking global liquidity flows. We do have to put a bow around it now, but really appreciate your time as always. Like, where can we send our audience to follow your work, Michael?
Well, I think the easiest area is Capital Wars, which is the Substack post that we write. That's published 2 or 3 times a week. We've got a website which is for institutional investors who want data, which is crossbordercapital.com. And those, I think, are the easiest ways to hook in, or you can use Twitter for the occasional tweet, which is at CrossBorderCap handle.
Fantastic. Michael, thank you so much for your time. It's great to have you back on. Really, really appreciate it. And everybody else, thanks so much for tuning in here to Soar Financially. Hope you enjoyed this conversation with Michael Howell. I always learned so much. Global liquidity flows are really important to understand what is moving the bond market. What is happening? What is driving markets in general? I should have asked him about the JGB manipulation that he touched on. We'll have to get Michael back on. Maybe we'll have that discussion over on X, but it'll be an interesting one. Thank you so much for tuning in. Leave a like, leave a comment, and if you haven't done so, hit that subscribe button. It's a free way to support us, and we tremendously appreciate it. Thank you so much for tuning in, and we'll be back with lots more. Take care out there.